Hey, how's everybody doing? It's a good day today. I got more dividends coming in this week, so I'm excited. That being said, let's kick right into it. We're talking about preferred shares versus closed-end funds. All right, these are all part of my income portfolio. Okay, as an income investor, I invest in income investor. I'm also dividend growth and index funds, but income is obviously my favorite. If you've read a lot of my work. So, disclaimer, these are very dangerous products. Okay, if you don't know what these things are, don't go investing in them. All right, now when you know what they are, they're actually pretty quote unquote harmless for the most part. However, you have to know what they are. They have to fill a specific goal in your portfolio. All right, don't just go off and start investing and doing this stuff without knowing why you're buying it, what you're buying, how they're going to react to certain market conditions, yada, yada, yada. All right, so you want to keep reading up on these things, and when you do jump in with potentially 1-2 shares. Sit on it. Wait till you get at least one dividend first. And then you want to keep continuing on. Okay, so these are very dangerous. All right, I didn't just jump in and start investing in these things. All right, it's been 2 years since I read The Billionaire Secret, which is all about preferred shares. Okay, and then I read, I think it's Step by Step Bond Investing, which told me about closed-end funds. Okay, that it's been about roughly 2 years. So I jumped in very small, and I actually have content articles. When I first jumped in, I had maybe $100 in preferred shares. Now I have, I don't know, $3,000, $4,000, $5,000, $6,000. Same thing with closed-end funds. I have closer to like 10,000 in those. Okay, if not more. All right, but okay, take your time, learn about them. Go to Seeking Alpha. Okay, read my content, get comfortable, put in 20, $30, sit on it, see how they ebb and flow, and then go forward. All right, you don't want to put a lump sum of money that you need into any of those products. Okay, because chances are the value is going to go down. Okay, and I'll explain why. Now, let's go into preferred shares. Preferred shares are like bonds almost. Okay, they're not bonds. They're equity, meaning that they're shares. They come out of the profits of the company. However, they have a par value, meaning usually around $25. So when they get issued out to the buying forces like us, they say, okay, hey, at par value at $25, we'll give you a $2 dividend, etc. Okay. The good part is they trade on the open market, meaning that you can buy that $25 par value for maybe $19, $20. Your dividend stays the same. So what does that do? Your dividend yield increases. Your dividend payment increases. All right. It might still stay at $2, but you're only paying $19, $20 for the thing. All right. So it's very easy to evaluate if you're getting a good deal on your preferred shares. Now, why is the price down is the question. All right. Now, keep in mind that they go up and down. So you have to research the company that gave the preferred share to see if they're doing okay. They can make sure that they haven't broke, that they've always paid that dividend for 3, 4, 5 years, whatever. And then see if you, before you even buy too many of them, buy maybe sit on for like 5 or 10 of them for a year, get comfortable with it, get 4 payments, and you're like, okay, let me double down a little bit more. All right, so preferred shares. Okay, so you look at the par value, and then you can make a investing thesis. You can make a buying decision. All right, look at your yield. Okay, both of these products you want to try to buy undervalue, right? You want to try to get a deal out of them. Okay, both of them. Now, closed-end funds, they're like ETFs. All right, they're a conglomerate of shares of different stocks and companies and everything. But the difference is they're closed. Okay, ETFs are open. So meaning if 1,000 people buy ETFs, the value of they would just keep buying more shares and stocks of Tesla, Apple, whatever, so they can meet demand. Okay, close end means when they first start the fund, they say, hey, here's 10,000 shares, fight. Okay, then everybody just fights for it. Okay, so that means they have a net asset value, a NAV. Okay, so you can compare a closed-end fund, since they're not adding more shares, you can compare it to the NAV and see where the value is. So basically, like when you buy a house and you have your property taxes say your house is maybe worth $200,000, but Zillow says it's worth $300,000. Okay, so the NAV is like the property tax value, the assessor's value, and then whatever the market is the market is. Okay, so when you buy a closed-end fund, you want to make sure that you're not too far away from the NAV or whatever. All right, so it depends on different things, right? So different managers, really good managers, you're going to pay a premium to the NAV. And sometimes you can get them under NAV. Right now, everything's in a tank, okay? So everything's under NAV, everything's struggling. Bonds are struggling all over the place, right? So if you believe in the long-term America, then it's a nice time to buy, right? I'm buying hand over fist, everything, okay? Because I believe America is going to recover. I believe bonds are going to recover, okay? So closed-end funds are a little different. You got to do a little bit more evaluation between the NAV and the manager of the closed-end fund to see if they historically trade at a premium. So this is a little more research, okay? So this is just an introductory video, okay? I'm not going to go too deep because there's real professionals out there that you can research, okay? I like to go on Seeking Alpha and make sure that I'm researching. And then when I do jump in, I jump in very small. I watch, I wait. I look at the market reaction. Okay, if something is really low, I buy a couple, see how it reacts. I might even wait for it to go up a little bit. Okay, it's better than jumping in all in and losing money, right? And if it starts to like go up and down, go up a little bit, I'm like, okay, cool, right? Let me jump in. All right, so now that's a little background on each. Now let's do a quick comparison of the two. Okay, so the most important part of this scenario, or both of these, is what? Research. It is super hard to find preferred shares. Extremely hard. Not only do you have to research to find the preferred shares, then you have to research the company. And if you're not good at researching companies, which I'm not, then you have to find your own metrics to research the company. A good metric I use is if they're paying a common dividend, then they have to pay the preferred dividend. So if I look and they're paying their common dividend, chances are the preferred stock is in good shape. Okay? So research. Closed-end funds are so much easier to research. You can pull it up. You can see what they're investing in. You can look at their 10-year history, what their thing. You can look up the fund manager on their websites. You can look at their goals, their inputs. Closed-end funds are easy. Okay, so research closed-end funds win hand down. Okay, hands down. Preferred stock, when you find a good deal, stick with it. I got about 4 good preferred stock that I can keep putting money into. But once they get recalled, right, once the company buys them out and I get my par value, then I got to search for some more. So I try to keep some more in the pipeline, but they're rare. In 2 years, I've only found like 6 to 8 preferred stock and 4 really good ones, okay? Good yields. Okay, capital gains. All right, you don't invest in both of these for capital gains. However, if you're buying a par $25 par preferred stock and you buy it for $17, chances are you're going to get your money back because when the company recalls it, they pay $25. Now, chances are you're not going to go further than $25, but if you buy 100 shares at $17, right, and then you make an $8 profit on each, plus all the dividends in between, that's a good chunk of change. Okay, so you preferred stock, you don't look for the upside. Okay, same with closed-end funds. You're not going to get some super upside. Like right now, bonds are down, so a lot of my funds, my PIMCO funds, are down in the SEF world, in the closed-end fund world. Right, they're down. Right, so I can keep buying, averaging down, and then chances are it's going to go up. It's going to go back to normal. Cool. And I'll sit on some capital gains, but I still want my income, so I'm not going to really sell, right? So you're not really buying both of these for capital gains, but however, preferred stock, you have a better chance because your shares could get called away by the company, and then you'll make that profit. So if you're under the $25 par, even if you're at $22, you're going to collect all those dividends for free and then get paid out extra $3 on each share. It's not a bad gig. It's not a bad gig, okay? So now income. You can get good yields on both of them. Anywhere between 9 to 13% based on when you're investing. If you're doing your research, buying at the right times, not getting greedy, you're going to get good income. Now, your chances are of you getting reliable income is with closed-end funds. All right, because you can find a preferred stock that's giving you a 13% dividend yield because the market doesn't favor that preferred stock. You jump in, you grab it, and then it goes up. It goes back to par. You're not going to get that 13%. You're going to go whatever the going rate was, which is probably closer to 9 or 8. And you're going to have to wait a year to get that down to 13 again, right? So that happened to me. I got in at like 17%. And then it went all the way back. I bought a preferred stock at $13. I bought 30 of them. Then it jumped all the way back to $25. And it's been sitting at $25 for over a year and a half. So I can't buy more. I mean, I could, but I like looking at my 17%. So a closed-end fund is going to give you better long-term income because you can keep investing, right? Chances are, without this market crash and the Fed playing with the bond rates, chances are you're going to get better income over the long term because you could just pretty much dollar cost average and buy every single month, right? For the most part, with the closed-end fund, you're going to sit around the same price, somewhere between, let's just say, $21 to $24. You'll just keep dollar cost averaging, and you get a nice income, right? So the goal of income investing is to replace the paycheck. Okay, it's not necessarily for dividend growth and they build this big nest egg. It's literally like I get paid $5,000. I need $5,000 in closed-end fund and preferred shared income, right? And that's the fastest way to get it, right? Okay, and then value. Okay, so the value of the different entities, right, between closed-end funds. I put closed-end funds just because it's hard to get preferred stock outside of like major banks. Schwab and Wells Fargo, I have all my preferred stock in. Closed-end funds, even they're hard to get, but they're at least in M1 Finance. Okay, so these, since they're very quote-unquote dangerous to the average person, they're not on Cash App or Stash. Okay, so, but with M1 Finance, I made a income portfolio with 10 stocks, and they're all closed-end funds for the most part. And I can just drop in $600 a month, and then it'll average it out, and then it'll spread load it across my little portfolio, and I don't have to worry about it, right? I'm not having to research. I've already done the pre-research, and that's the good thing about closed-end funds and the value. Once you do the research up front, you're good. You could pick your 5 closed-end funds, and you also can find different industries. So you can have closed-end funds for housing, for energy, for construction, infrastructure, medical. There's medical ones. So there's some really good. They're almost like ETFs, but they use leverage, which makes them a little riskier. But at least you'll be diversified, right? And preferred stock, you're just trying to figure out a good company, and you're just trying to kind of get in there, and you're not really. And preferred stocks is mainly like more mortgage REITs and banks kind of are your preferred stocks for the most part. Maybe a little bit energy, very limited, right? Most people don't want to do preferred stocks. There are some preferred stocks like AT&T, but they're very like 4%, something like that. But anyway, so for value, I put closed-end funds, right? Because you can diversify, you can invest with M1 Finance. You do the research up front. It might take you a month to find a couple good ones, and you can be in those same 2, 3, 4 for the 4 or 5 years. You know, some of these PIMCO funds have been around for a long time, 20 plus years. So you just sit in those things, and you're good, like because you're just there for the income. You know, you read about another one, you tack it in. Preferred stock, you got to be, not only you have 3 or 4 good ones, but you always have to be on the lookout, because once it's past its recall date, it can get recalled, and then say that's, you know, say you're getting $1,000 a month from one preferred stock, cool. And then it gets recalled, you'll get all your money back for the most part, but then what? And then you got to search again, so you got to always keep a couple of them, you know, in the baseline on the side, so you're ready to, you know, jump into those things. So preferred stock's ongoing, but again, you can get those good yields and you can get those good capital gains off preferred stock. Okay. So yeah, these are very deep topics. I wanted to go deeper. Usually I kind of skim off. This is just get your mind working. Okay. My content is geared for you to get your mind working, and then you continue to research. Okay. I let you know all the books I'm reading, where I'm getting my information from, so you can read the same stuff. All right. I'm not going to tell you exactly where to invest, because you don't want that. You want to be able to decide, right? So you can teach a man to fish, right? So you want to decide for yourself what's good, what's not. What can I put my money into? How much I want to put in? Can I play around with it? All right. So again, do your research. These can be dangerous products. However, once you trust them, once you understand them, they're very powerful products, life-changing. So I'm using a method now where I go to work. Unfortunately, I got work. So I got a couple more years of work. I go to work. I get my paycheck. I put my paycheck into high-income products. Okay. Now, when those high-income products pay me, then I put those dividends into dividends and dividend growth stocks and index funds. Okay, so I'm kind of using a tiered system now. That way I'm making sure I get my high yield, I get my 9 to 13%, and then I go buy my 4%ers and stuff like that. But then again, I already have a nice dividend growth portfolio I started 3 years ago. I have index funds I bought 3 years ago. Okay, so I'm kind of set up to where those are already growing on themselves, and now I'm just adding to them once I get more high-end dividends. That way I have my nice, so I'm basically building another paycheck for myself, and then from that secondary paycheck, I'm buying even more. All right. So that's super deep, when you start investing in your mind, you start reading, you start just like doing weird crap. Right. And you got time, and you like looking at numbers and doing calculations. All right. And if you don't like doing math, you probably should stay away from these. All right. These are all math based, right? You want to know, you want to look, you want to do calculations, you want to look at the NAV, the net asset value, you want to look at the rates. Okay, so preferred stock, you want to look at your rule of 72. Okay, so 72 divided by the dividend yield tells you how long it takes to double, right? So obviously if you have a 13% yield, your money's going to double faster. You have a 5% yield. Okay, so those are very important for preferred stock, because you can get in, get out, double your money, plus get the payout. So you get all your money back in dividends, and then they recall it, you get all the capital gains. And preferred stock, read the book, The Billionaire Secret. It'll change your life. Like it really will. Because you don't have to really guess anything. Once you find your good preferred stock, the company's good, you're good. You buy cheap, you hold on to it, it gets recalled away, you get the capital gains plus all the dividends. It's literally free money. You put risk, right? So you have risk, so you get paid for your risk, right? So anyway, I'm rambling because I like to ramble. These are things I like to talk about. But yeah, okay, I'm sorry I didn't mention that. Free book, of course, grab it. And this is one of my better selling books on Amazon. I sell probably 1 or 2 copies a month. So it's not bad. People are looking into these preferred shares and closed-end funds, okay? They're a good piece of kit, right? They can, as you head towards retirement, I would rather have this nice, $3,000, $4,000, $5,000 income from them, and then, have my dividend growth on the side, right? I don't want to really interrupt my dividend growth portfolio of Costco and Microsoft and all those guys. Let that stuff grow. It'll grow into a nice income stream as well, but I don't want to interrupt that, right? I take my income straight up. Anyway, I will see you next week. Thanks for listening. Download the book. Show your friends. Tell your friends. Okay, I got my free book schedule. Grab in there. Also on my free book schedule, I put all my free PDFs at the bottom. So you have one place, one shot, one kill. I got like 450 books out there now. If you want to collect them all, like Pokemon, go ahead. I have them all. Obviously, I created them, so it's good. But yeah, like if I keep going, one day I'll become popular and they might become worth something. The physical books. So look into that. I just want to do good things, right? I want to pay it forward. I didn't know about money growing up. I suffered the consequences of not knowing about money, right? I tried to live the American dream. You had to build your American dream with hard work, understanding, reading books. Okay. So with that, I'm out. Bye. Thank you.